Welcome to another video, weekly market commentary. And today I really want to touch base once more on the labor market chart book that we released last week. And the reason that it was such an important release for us and kind of focusing on the labor market is because I want to tie it to the notion of a recession, right? The likelihood of this inevitable recession that is all over the news and likely has been a dominant factor in a lot of people's thought process. The reality is that any recessionary period that we may enter over the next 6 months, let's say, right? Or when it's officially announced, if that's the case, we have to take that into consideration relative to other factors, and the labor market is a critical component of that. And the reason it's so critical is because presumably, if we do enter a recession, the current health of the labor market, right, as it currently stands today, even when we extrapolate it forward, is one that has never been indicative of a hard landing in the economy or that of an elongated kind of strong downside recession. And I'm going to put that in perspective in a couple of ways. Number one, right, the previous true detrimental recession in the US was that during the great financial crisis in the 2008-2009 era. And it was roughly December 1st, December 2nd of 2008 when it was officially announced that a recession had hit in the United States. The reality is, throughout 2008, through the official recessionary announcement, the US labor market had lost approximately 1.5 to $2 million jobs before the announcement of that official recession. Prior to that, during the technology bubble of the early 2000s and that recession, before the announcement of that recession, there was a notable loss in jobs across the country. Taking that into consideration in today's environment, engaging what is the likelihood of a severe recession as gauged by numerous of unemployed individuals that are seeking jobs, and how does that kind of translate into the future? It's very difficult for us to quantitatively and objectively make an argument for a very hard landing in whatever may transpire over the next 6 months. One of the components that we released in our chart book last week was tracking things like number of job openings, and then also tracking job openings per unemployed worker. So the reality is when you have an economy as it stands today with roughly 2 million open jobs and roughly 1.7 available jobs per single worker seeking employment, that's a backdrop of an economic activity that is not indicative of a hard landing, not indicative of tremendous downside in economic activity. We can continue down that path in the entire chart book. We can look at the notion of sentiment data, of who thinks jobs are easy to get versus hard to get. That data is extremely and remains very positive. We can look at it in the same notion of the aggregate unemployment rate, where we are well below, in a good way, what's considered to be full employment, right? Unemployment below that 4% mark is considered beyond full employment in this case. So this is all relevant in today's environment because the notion of recessionary talk has been so ample. And we are getting earnings data this quarter to rather provide further information, rather solidify or not solidify the likelihood of a recession. And what we're seeing is quite interesting in that we're seeing sales growth across a subset of the S&P 500, with roughly 20% of companies having reported earnings. And we're only seeing a roughly -1% to -2% earnings downside. This is better than expected across the spectrum, having come off a massive 2021 and early part of 22 in earnings gains. So I want to put that into context for you because it's very easy to succumb to the notion of fear in the very short term as it relates to the potential for an upcoming recessionary announcement. The likelihood is that it's probably going to happen given the backdrop of what we've seen so far. Yet the severity of it, the downside of it, the impact of it should not be compared to things we've seen in the past, over the past 10, 15 years, because the data simply does not make it justifiable to do so. Thank you.